Jake sends an extra $500 to his mortgage every month. Marcus sends the same $500 into the stock market. Same age, same income, same house, same mortgage, same starting point. Jake believes Marcus is taking unnecessary risk. Why gamble in the market when you can destroy debt, save interest, and own your home free and clear? Marcus believes Jake is making an emotional decision that feels safe, but quietly gives up decades of compound growth. And for the first few years, Jake looks like the responsible one. His mortgage balance falls faster. His interest bill shrinks. His payoff date moves closer. Every month, he gets a little more freedom. Marcus, on the other hand, is watching his investment account move up, down, sideways, and sometimes violently backward. Some months, he looks smart. Other months, he looks like he should have just sent the money to the bank. So who actually wins? The person who pays off the house early? Or the person who keeps the mortgage and invests the difference? Professor Ben is going to run the math. And the answer is not as simple as most people think. Because the real question is not, should you pay off your mortgage early? The real question is, what return are you secretly choosing when you send that extra dollar to the bank? Let's make the comparison fair. Jake and Marcus are both 35 years old. They both have a $400,000 mortgage. They both have a 30-year fixed-rate loan at 6.5%. Their normal principal and interest payment is about $2,528 per month, and each of them has an extra $500 per month available. Jake puts that $500 toward the mortgage principal. Marcus pays only the regular mortgage payment and invests that $500 into a low-cost stock market index fund. For the investment side, we are going to use an 8% annual return assumption. Not because the market promises 8%, it does not. The market can fall. It can stay flat. It can test your patience for years. But for a long-term comparison, 8% is a reasonable assumption for a diversified stock portfolio. The point is not that this exact number applies to everyone. The point is, what happens when you compare a guaranteed debt return against a possible market return? Now at first, Jake's strategy feels obviously better. There is something powerful about watching debt disappear. Every extra dollar he sends to the mortgage immediately reduces the loan balance. And because mortgage interest is calculated on the remaining balance, Jake is not just paying down debt. He is reducing future interest. This is why paying extra on a mortgage feels so good. No volatility, no red days, no financial news, no market crash, no panic. Jake sends $500 to the bank, and the balance goes down. Simple, clean, predictable, and emotionally, that is very hard to beat. Now let's run the first number. With a $400,000 mortgage at 6.5% for 30 years, the regular payment is about $2,528 per month. If Jake only made the regular payment for 30 years, he would pay about $910,000 in total principal and interest. $400,000 is the original loan. The rest, roughly $510,000, is interest. That number shocks people, because when someone says, "I borrowed $400,000," it does not feel like they are signing up to pay more than $900,000 over time. But that is what a 30-year mortgage can do. The payment is not the cost. The payment is just the part they show you every month. Now Jake adds $500 per month. Instead of paying about $2,528, he pays about $3,028. That extra $500 goes directly toward principal, and the result is dramatic. Jake pays off the house in about 19 years and 5 months instead of 30 years. He cuts more than 10 years off the mortgage, and he saves around $205,000 in interest. That is not a small win. That is real money. $205,000 that Jake does not send to the bank. So at this point, Jake looks like the obvious winner. He gets a guaranteed return equal to his mortgage rate. In this case, 6.5%. When Jake pays extra principal, he avoids paying 6.5% interest on that money in the future. And a guaranteed 6.5% return is not a joke. Many investors would love a guaranteed 6.5% with no market volatility. Jake gets it by doing something boring. He sends more money to the mortgage. But this is where Professor Ben stops the celebration, because saving interest is only half the math. The hidden question is, what did Jake give up to get that guaranteed return? That $500 had another possible job. It could have gone into the market. It could have bought ownership in thousands of companies. It could have compounded for 30 years. And this is where Marcus starts to catch up. Marcus does not pay extra on the mortgage. He makes the regular mortgage payment and invests the $500 every month. At first, his progress feels less satisfying. Jake can see his mortgage balance falling faster. Marcus has to live with uncertainty. But Marcus has something Jake does not have: liquidity. His money is not trapped inside the house. If Jake loses his job, he cannot buy groceries with paid-down home equity unless he borrows against the house, refinances, or sells. Marcus may be able to access his taxable investment account. That does not mean investing is safer. It means it is more flexible. And flexibility has value. Now let's look at the 30-year result. Marcus invests $500 per month for 30 years. At an 8% annual return, his investment account grows to about $745,000. He only contributed $180,000 of his own money. The rest came from time and compounding. That is the power of starting early and staying consistent. Jake's money works differently. For the first 19 years and 5 months, his extra $500 goes into the house. Then his mortgage is gone. Now Jake can take the entire payment he used to send to the bank, about $3,028 per month, and invest it. That is powerful. Very powerful. But he is starting much later. He has about 10.5 years left in the 30-year comparison. If Jake invests that larger amount for the remaining years at the same 8% return, he ends with about $602,000 invested. So after 30 years, both men own the house free and clear. But Marcus has about $745,000 invested. Jake has about $602,000 invested. In this version of the math, Marcus finishes ahead by roughly $143,000. And this is the twist. Jake saved around $205,000 in mortgage interest, but Marcus still ends up with more outside the house because his money had more time to compound. Paying off the mortgage early saves interest. Investing builds a separate asset. Those are not the same thing. Jake's return is guaranteed, but capped. Marcus's return is uncertain, but potentially larger, and the winner depends on the gap between the mortgage rate and the investment return. This is the number Professor Ben wants you to remember. Your mortgage rate is your hurdle rate. If your mortgage is at 6.5%, every extra dollar you send to the mortgage is similar to earning 6.5% guaranteed. So for investing to clearly win, Marcus does not just need the market to go up. He needs the market to beat 6.5% after taxes, risk, volatility, and behavior. That is a much higher bar than people think. If Jake had a 3% mortgage, the decision would look very different. At 3%, paying extra on the mortgage is like locking in a 3% return. That may feel safe, but over 20 or 30 years, a disciplined investor has a much stronger case for investing instead. That is why people with very low mortgage rates often hear, "Do not rush to pay it off." But at 6.5%, 7%, or higher, the decision becomes much harder. Now paying extra on the mortgage is not just an emotional move. It becomes a serious financial competitor. This is why the internet fights about this topic so much. People argue as if there is one answer. There is not. A person with a 3% mortgage and 25 years until retirement is not in the same situation as a person with a 7% mortgage and 5 years until retirement. Same question, different math. Now let's talk about taxes. Some people say, mortgage interest is deductible, so you should never pay off your mortgage early. That sounds smart, but it is incomplete. Mortgage interest only helps you if you itemize deductions and if the deduction actually reduces your tax bill. Many households take the standard deduction. So for many people, the mortgage interest deduction may not change much at all. That means you cannot automatically assume your mortgage is cheaper after taxes. Marcus also has taxes. If he invests in a taxable brokerage account, he may owe taxes on dividends and capital gains. If he invests inside a retirement account, the tax treatment changes. If he uses a Roth account, it changes again. So the clean spreadsheet is never the full story. Jake's return is predictable. Marcus's return may be higher, but it comes with taxes, volatility, and behavior risk. And behavior risk is the one nobody likes to admit. Marcus only wins if he actually invests the $500 every month, not sometimes, not only when the market feels safe, not only after the headlines look good, every month, for 30 years. He has to keep investing during bad markets. He has to avoid panic selling. He has to avoid using the brokerage account for vacations, car upgrades, or a kitchen renovation he convinces himself is an investment. This is the invisible advantage of Jake's strategy. Money sent to the mortgage is harder to spend. It becomes forced discipline. That is not always mathematically optimal, but for some people it is useful. A brokerage account can build wealth, but it can also become a temptation account. If Marcus invests for 5 years, then panics, stops, sells, or spends the money, the spreadsheet result disappears. Not because the math was wrong, because the behavior assumption was wrong. Personal finance is not just math. It is math inside human behavior. Now let's be fair to Jake. A paid-off house changes how life feels. If Jake loses his job after the mortgage is gone, his required monthly expenses are lower. If he wants to change careers, start a business, retire earlier, or work less, the paid-off home gives him breathing room. That has real value. There is a reason people feel emotional when they make their last mortgage payment. A house without a mortgage is not just a financial asset. It is psychological relief. And we should not pretend that does not matter. But Marcus has something powerful too. He has growth and flexibility. His portfolio gives him options. It can help fund retirement. It can be rebalanced. It can be partially sold. It can compound outside the walls of his house. A paid-off home gives Jake stability. An investment portfolio gives Marcus optionality. The question is not which one sounds smarter. The question is which one fits the numbers and the person. And here is something most people forget. You do not have to choose one extreme. Jake and Marcus could split the money. $250 extra to the mortgage. $250 invested. This may not produce the highest possible spreadsheet result, but it may produce the plan someone actually sticks with. You get visible progress on the debt, and you still give the market time to work. You do not pay off the house as fast as Jake. You do not build the portfolio as fast as Marcus, but you may stay consistent. And consistency is the engine. So when does paying off the mortgage early make sense? It can make sense if your interest rate is high. It can make sense if you are close to retirement. It can make sense if you already invest enough for your goals. It can make sense if your income is unstable and you want lower fixed expenses. It can make sense if you know that money in a brokerage account will not stay invested. And it can make sense if the emotional return is worth it to you. Peace has value. But be honest about what you are buying. You are buying certainty. You are buying lower debt. You are buying emotional relief. You may also be giving up higher long-term growth. That trade-off can be worth it. But it should be conscious. Now, when does investing instead make sense? It can make sense if your mortgage rate is low. It can make sense if you have decades before retirement. It can make sense if you already have an emergency fund. It can make sense if you are getting your employer match. It can make sense if you have no high-interest debt. It can make sense if you can invest consistently and stay invested through volatility. And it can make sense if your realistic long-term investment return is meaningfully higher than your mortgage rate. That word matters. Meaningfully. If your mortgage is 6.5% and you think your investment return might be 7%, that is not a huge gap. You are taking risk for a thin spread. But if your mortgage is 3% and you have a 30-year horizon, the spread may be large enough to justify investing. Again, not guaranteed, but much more compelling. Before doing either strategy, Professor Ben checks the foundation. Do you have an emergency fund? Are you getting your employer match? Do you have credit card debt? Because paying extra on a 6.5% mortgage while carrying credit card debt at 20% is usually backwards. And skipping a 401k match to pay extra on the mortgage can mean rejecting free compensation. So the basic order is this: protect yourself with cash. Get the employer match. Destroy toxic high-interest debt. Then decide whether extra dollars go to the mortgage, the market, or both. That is the adult version of the conversation. So who wins? In our example, Marcus wins by about $143,000 after 30 years. But Jake still made a strong decision. He saved a huge amount of interest. He removed the mortgage more than 10 years early, and he bought peace of mind. Marcus won the spreadsheet because his money had more time to compound. Jake won the emotional race because he reached mortgage freedom earlier. The right answer depends on what you need your money to do. So here is the final rule. Your mortgage rate is the guaranteed return. Your investment return is the possible return. The difference between those two numbers is the real decision. If your mortgage rate is low, your time horizon is long, and you are a disciplined investor, investing the difference often has the stronger wealth-building case. If your mortgage rate is high, retirement is getting closer, or debt is creating real stress in your life, paying extra on the mortgage can be completely rational. And if you are torn between the two, split the difference, build wealth and reduce debt at the same time. Because the goal is not to win an argument online, the goal is to build a financial life that works. The mortgage is not just a debt. The stock market is not just a return. They are tools. And the wrong tool used at the wrong time can turn a smart strategy into a stressful one. So before you send extra money to your mortgage, run this number. Is this dollar more powerful reducing debt or buying time in the market? That is the number most people never calculate. And that is where the real financial math begins. If this video helped you see a number you were missing, hit the like button, subscribe to The Real Financial Math, and tell me in the comments which side you would choose: mortgage freedom or stock market wealth.